Hello, Lucas. How are you? So welcome. Uh, so today I want to talk about another form of gap or form of internal liquidity that we have. So as I said before, we have got different type of internal liquidity that we have. Okay. So this is another type of internal liquidity that we have. So as you can see, this is the Friday, 16 January 2026. Okay, this is the last print. Okay, then the next print was Sunday, 18 January 2026. So we have got a gap here, as you can see here. So if you are going to take this high first, this is external liquidity, right? And also this low, right? So we have got two external liquidity points, this one and this one. As you can see, these are relatively forward lows, and we also have this relative equalize that we have here. So we now have a gap. So what type of a gap is this one? Now, what type of a gap is this one? This one is a weekly gap. Why? Because we have got this, okay? We have got last week closing price and this week's opening price. So this one is in we call it new week opening gap. New week opening gap. So when we call it new week opening gap, how does it work now? How does a new week opening gap works? New week opening gaps works like this. Price will refer back to it. Price as of now, price isn't referred back to it. Okay, as you can all see here, price will refer back into this. Okay, because this is a void. There is nothing here. There is nothing that was printed between this closing price and this opening price, right? So we'll be having what we call price will come back to this gap. Okay. As we said before, we don't want to see market doing what to call a leave some void, okay, leave some open space that you might think of. Okay. So let us look for another example whereby the market came back to it and it uses that gap. Okay. So we have got two types of gap: new week opening gap and the new day opening gap. So a new day opening gap will be like a for a J section. Like if you are going to use NQ uh, futures, we are then going to see what I'm talking about. Like this, if you say NQ, let's just pick this one. Not that one. Right. S&P futures. SP 400. Yeah. Okay. It's a NQ. NQ. I, all right. Let me use this one. Okay, let me use this one. Let me remove these drawings. Okay. So on this NQ, we have got what we call We have got different trading hours. We have got regular trading hours. What is regular trading hour? Regular trading hours closes, okay? Closes at what? It closes at what? At 1600 hours. Then open the next day at 9:30. Okay. As of today, okay, today is Wednesday. So this one, the market is not moving as of now. It will start to move it around 9:30. 9:30, yeah. So we don't know if it's going to open, to do the opening to the upside or the downside. So when we are in regular trading hours, this gap here from this, from previous day to the current date, this is what we call new day opening gap. Okay, so this is new day opening gap. Okay, so we have a new day opening gap. This will happen from Monday to what? To Friday. And then the one that happened between Friday and Monday is what we call new week opening gap. So as I said, price will refer back to it. As you can see, if we say we'll do it like this. So you see, when this candle opens here, the market came back and refer back to what? To this gap that you see here. So that is how it is going to work. It will work like any other like any other, what do you call it? Like any other it might be fair value gap or it might be order block or anything else. So it will work like that, right? Then we have got what we call electronic trading hours. This one is the continuous chart that you have. It doesn't have any break or anything like that. Okay. So as you can see now, the market is moving. While it's in regular trading hours, it's what is closed. Okay. So on regular trading hours, it will open it not at 9:30. So as you can see here, from this side, let's take from this side, okay, to this low, right? To this low. These are relatively what equal equal lows, and these are really also relatively equal highs. And when we took out these relatively equal highs, where are we most likely to go to? We are most likely to come in cover this one, this new week opening gap. Okay. That's how these things are like. So you guys, you need to go and look for it into your charts and see how these things are referred back to like. Okay? So it's not a big deal actually. It's not a big deal and you don't have to worry about it. But it will work like any other paper games that you know, that you might think of. Okay, as we said, this is the midpoint of it. So this will be discounted, this will be premium. So you want to know when you see the market coming here, how is it going to react at that at the midpoint of this new week opening gap, okay? So how is it going to react? If it's going to react and make some sweep to the upside here and the candle closes below, there's a confirmation that we are likely to go lower. So you do according to what? To your analysis, according to how the market is giving you these options. So next we are going to talk about the breakers. Okay, breaker, breaker and order block. On the next video, we're going to talk about breaker and breaker and what? What did I say? I said breaker and order block. Okay, how are we going to use breaker and how can we use it to our advantage? Till we meet again, folks. It's bye bye for now.